In this video, in under 5 minutes, I want to tell you the difference between a Roth 401k and a traditional 401k and provide you with all the information that you need in order to make your decision on what's going to be right for you. Hi, my name is Zach Morris with Paces Ferry Wealth Advisors, and I'm going to talk to you about all of the different options that you have between a Roth 401k and traditional 401k and why you might choose one over the other or how you can choose both together. In a traditional 401k, the money's going to go in pre-tax, it's going to grow tax deferred, and it's going to be taxed at the time that you take it out, usually much later in life. Eventually, you have to take what's called required minimum distributions. Today, it's at the age of 73, but you can take the money out after age 59 and a half. But when you take that money out, because you've never paid tax on it, you will pay ordinary income tax on that distribution, and you will recognize that distribution as ordinary income. A Roth 401k, on the other hand, goes in after tax, the money grows tax-free, and it comes out tax-free for whatever expenses that you need to pay for in retirement. When the money comes out of a Roth 401k, it's not taxed because it was already taxed when you put the money in. So it goes in after tax, grows tax-free, it comes out tax-free. It also doesn't affect your income in retirement. So you can take money out of a Roth and it doesn't affect your total income, doesn't affect your tax brackets in retirement. So here's 3 reasons why you might want to contribute to a Roth today. Maybe you're young and you think your income is going to be going up in the future. Well, if you contribute to a Roth today, you're going to pay the taxes at potentially a much lower tax rate, right? And then your taxes go up in the future when you grow in your career and your income goes up. The second reason is that maybe you just want to pay the taxes and be done with it. Maybe you think that taxes are going up in the future and you say, I don't care what my income is today. I'm in a high income bracket, but I'm just going to go ahead and pay it, be done with it, and not have to think about it because I don't want to get into retirement and have $1 million in a retirement account and know that it's not worth $1 million to me. Because with the traditional 401k, I'm going to have to pay tax on that money when it comes out. But with a Roth, if I have $1 million in a Roth at retirement, I don't have to ever pay taxes on that money again, right? So it's a much powerful savings vehicle in that regard. And so maybe, regardless of how much money you're making, you just say, I want to pay it and be done with it. The third reason why you might want to consider using a Roth 401k over a traditional 401k is that you already have so much money in a traditional IRA or in pre-tax money. So from a tax planning standpoint, when you get into retirement, if all of your money is in a traditional 401k or traditional IRAs, then the only way you have to access money is to pull money out of those accounts. And if you pull $200,000 out of your IRA in retirement, you're going to realize $200,000 worth of income. So if you have Roth assets in retirement, you can mix and match. We had a client the other day that had a short-term cash need that was unexpected, and instead of increasing his income by $50,000 by taking the money out of an IRA, we were able to take the money out of his Roth IRA, and his income is now going to be consistent from year to year. Just the same, if you were to have a big taxable event in retirement, let's say you sold a piece of real estate and your income went up significantly because you had a big gain. Well, that year, maybe you spend less money out of your IRA and spend more money out of your Roth IRA to level the playing field, to level the amount of income that you're realizing that year. So because a traditional 401k goes in pre-tax, it affects your tax bracket because it can lower your overall taxable income. Okay, so it can lower your effective tax rate, essentially. So if you make $250,000 a year, you put $23,000 into a traditional 401k. Even though your income was $250,000 a year, that's how much your salary was, you only realized $227,000 worth of income. So you're only paying tax on $227,000. Now, with a Roth 401k, you're going to pay tax on that money first. So you're going to pay tax as if you made $250,000. And then the after-tax money is going to go into a Roth 401k. So You say, why would I use Roth over traditional or traditional over Roth? One of the reasons why is because a traditional 401k is going to hurt your take-home pay less. So you're not going to feel it as much in your paycheck because it's going in pre-tax. Okay? So because it goes in pre-tax, it affects your take-home pay less. Now, if you start to contribute to a Roth 401k and you say, you know what, this is too much, it's really affecting my take-home pay, I need some more money to live. What you can do is you can go back and you can split it. You can say, maybe I'll do 50% in a traditional 401k and 50% in a Roth 401k. So you don't have to put it all into one or the other. Now, if you're getting a match or a safe harbor, if you're any type of employer contribution, so what we're talking about right now is employee contributions. Any type of employer contribution is going to go in pre-tax, right? Because the employer is not going to pay the tax for you. So that's going to go in as if it's going into your traditional 401k. So even if you put money into the Roth, employer contributions will go in pre-tax. So you will get some tax diversification either way if your employer is making contributions for you. If you found this video helpful, please subscribe below and give me the thumbs up, and be on the lookout for more videos from this channel. Thank you.